Hello everyone, I am Buddhikettiarachi. Today I am going to discuss about some important contents in our syllabus. Our subject is 103 Economics. This is the content of our syllabus. Section A, it includes 100 marks out of 100. 40 marks allocated for Section A. Section B, 40 marks, as well as Section 3 or Section C, 20 marks. There is a one compulsory question with 20 marks. In our syllabus, we can see a weightage. Economics concepts and systems related to business environment. It takes 50% of weight in our syllabus. Demand, supply, equilibrium and ways of government intervention. It takes 20%. Behavior of production, process and different market structures. It takes 15%. National accounting and role of the government. It takes 20%. Financial system, money and general price level, it's inflation, 15%. International trade and foreign exchange market, 10%. Economic growth, development and new trends in the economy, 5%. Why should I give you a brief introduction about this weightage? Because you have to pay your attention on these 7 sections, as well as you have to give your priority to the lessons which have more weightage, especially demand, supply, equilibrium, and ways of government intervention, and the national accounting and role of the government are the most important 2 lessons in our syllabus. Why? It takes 40% out of 100 in our syllabus. So, give your priority to these 2 sections, especially we don't have enough time to discuss each and every lessons in our syllabus. But today I am going to discuss the weak points and the content and the suggestions given by the examiners, because they have highlighted some weak points in this section. So today I'm going to discuss demand, supply and equilibrium, as well as the what are the types of government interventions and what are the impacts of government interventions. So this is the brief introduction. So you have to understand the nature of the examination, as well as you have to understand the content as well as the syllabus of our examination. Otherwise, we will be unable to reap the maximum fruit of our learning process. Here, under demand, supply, equilibrium, and ways of government intervention, at the very beginning, I said you it takes 20% of weightage. Under this section 2, under this lesson, what are the things we have to learn? What are the lessons need to be taught you? Consumer equilibrium, you know how consumers get the maximum utility based on the constraints as well as based on their income level. With the minimum income level, they have to get the maximum utility. What is the condition for consumer equilibrium? This is not the market equilibrium, demand and supply. This is consumer equilibrium. You know utility curves, marginal utility theory, cardinal utility theory. This is the thing in the consumer equilibrium. Second thing is theory of demand and law of demand. This is very important. What is the theory of demand? What are the factors which determine demand? As well as what is demand function? As well as what is the law of demand? Law of demand discusses the negative relationship between price and the quantity demanded. When price increases, quantity demand decreases. When price decreases, quantity demand increases. This is the negative relationship between price and the quantity. How can we show it? By using demand schedule, by using demand curve, by using demand equation. We can use these three methods to show the law of demand. As well as, what are the reasons behind this demand, law of demand? Then substitutional impact of change in price, as well as the income effect of change in price. This is very important because all the time the examiners try to check your understanding about the reasons behind demand curve, demand, law of demand. Next, then another part in the market is supply. It represents the producer's aspect. Then theory of supply and law of supply. Theory of supply. What are the factors which affect supply? Price of the good, price of the other goods, then technology, then cost of production, then government intervention, then other factors, weather conditions. These type of factors which affect to supply. As well as law of supply, similar to law of demand. Under law of demand, we discuss the negative relationship between price and the quantity demanded. But here we are going to discuss the positive relationship between price and the quantity supply. It means there is a positive. When price increases, suppliers supply more. When price decreases, suppliers supply less because they want to accrue more and more profit. So there is a positive relationship between price and the quantity supply. Then these are the two forces in market economy. Then demand and supply together we put as into the frame. It's called market equilibrium. Then next section is the market equilibrium. Today we will discuss market equilibrium. So I have highlighted that part. So I'm not going to discuss it in here. So after explaining these sections, then I'll move to market equilibrium. Then determinants of demand and supply and their influence on the equilibrium price. Equilibrium is not static, fixed. It changes due to change in some factors. So I'll explain it later. Next one is the elasticity of demand. Elasticity. Change in demand due to percentage change in demand. The responsiveness of quantity demand to change in factors which affect demand. If we take price of the good, income of the good, income of the consumer, then price of the other goods. These are the two factors which affect elasticity of demand. So we are going to discuss price elasticity of demand, the responsiveness of quantity demanded to change in the price of the good, income elasticity of demand, the responsiveness of the quantity demanded to change in the consumer's income, then cross elasticity of demand, the responsiveness of the demand to change in price of other goods, especially what will happen when petrol price increases, what will happen to the demand of motor vehicles, that kind of things there, as well as their influence. Next, price elasticity of supply. No, there is no income or other factors, but only the price. So price elasticity of supply, the responsiveness of quantity supplied to change in price of the good. Next thing is the consumer surplus and producer surplus. Again, I have highlighted here. So I'm going to discuss here, then later I will discuss consumer surplus and the producer surplus. Next, the influence of demand and supply concepts in business operations. Why should we learn about demand? Why should we learn about supply? So we have to understand the past, political, economic, social, and technological environment. Then economic factors will affect to business environment of a business. Then under economic factors, what will happen to increase in prices? Then this is very important during a during a very big drought period. Then supply will decrease. So what will happen to the market price of paddy? During New Year season, during Christmas season, what will happen to the price of chicken? So demand and supply concepts are very, very important when we take decisions, because we have to take decisions. We have to apply demand and supply concepts to take decisions. That's why we have to learn these kind of lessons. Next is the way of intervention by the government to the market. It is also highlighted. So I'm going to discuss these highlighted lessons one by one, because ways of intervention, there are different ways. Government, Adam Smith said that government should refrain from the market, but government has a role in an economy. So we are going to discuss what will happen when government intervene into the market. So now you have a clear idea about what we are going to discuss. So according to the examiner's report, these are the low performance areas based on the previous examination, 2023 March exam. So these sections are indicated there, low performance areas. So it is very important to understand and to have the clear and understandable knowledge about these factors. Now we are going to discuss equilibrium. What is meant by equilibrium? We are going to equal something. If we take an example, scale in a shop, butcherman or businessmen try to balance. This is called equal something. So market equilibrium tries to balance the market. There are two forces in the market. So at the equilibrium point, the demand and supply are equal. There's no excess demand. There is no shortage in the market. Current demand is equal to current supply. So I'll explain you. Here, according to this demand schedule, you can see different price levels as well as the different quantities. Quantity demanded and quantity supply. I'll give you 15 seconds. Try to see the table. Yes, according to this table, you can see when price increases, quantity demand decreases. Price 0, quantity demand 12. Price 1, quantity demand 10. It is low of demand. Negative relationship between price and quantity. What has happened to the supply? When price increases, quantity supply increases. There is a positive relationship. So there is a contradiction. Two different forces. Consumers are willing to buy more and more goods when price decreases. Suppliers or producers are willing to supply more and more goods when price increases. So you can see here highlighted area under price level 3 at 3. Here quantity demanded equal to quantity supply. consumers have demanded 6 units from dal or from potato, here, any goods. Then quantity supplied, farmers have supplied 6 units. So there is no shortage or excess in the market. But all the other prices have excess or shortage. Okay, here. Then the price, equal price is called equilibrium price. Equal quantity is called equilibrium quantity. This is the equilibrium by using demand schedule. Now we can show this using a diagram or using demand and supply curves. Here there are two opposite cases. When price increases, when price increases, quantity demanded decreases, law of demand. When price increases, quantity supply increases. But at market equilibrium price 3, the demand and supply curves intersect each other. It means market is optimal, or there is no shortage or there is no excess in the market. We can go further. Here you can see this table. Here, under market price level 0, quantity demand 12, quantity supply 0. Here, there is no supply, but there is a demand. So excess demand is equal to 12. How we calculated excess demand? ED equal QD minus QS. QD minus QS. QD 12, QS 0, 12 minus 0, 12. It is called excess demand. Under price level 1, quantity demand 10, quantity supply 2, then excess demand is 8. But at price 3, the quantity demand is 6, quantity supply is 6. So excess demand is 0. So we can see there is no excess demand in the market at equilibrium price. As well as at price level 4, demand is 4, supply is 8. So excess supply is 4. But at price level 3, there is no excess supply in the market. So second point is, there is no excess demand or excess supply in the market at equilibrium price level. This is second point. Next, by using demand and supply equations, we use two methods, demand schedule, demand curves. Then the third one is by using demand and supply curves. Equations. Here, according to previous example, demand equation is QD equal 12 minus 2P. Supply equation equal QS equal 2P. We understood that at market equilibrium, QD equal QS. So we can substitute numbers to QD and QS. 12 minus 2P equal 2P. We can take P as the subject. Then equivalent price is 3 according to this equation. By substituting price, equilibrium price, to the demand equation or supply equation, we can find equilibrium quantity. According to this example, equilibrium quantity is 6 units. There is no excess demand or excess supply in the market under price 3. QD equal to QS, you can see here. Now we will move to some concepts under market equilibrium, especially the consumer surplus and the producer surplus. These are two very important concepts under market equilibrium. What is meant by consumer surplus? Here you can see a diagram. At market price 3, quantity demand and quantity supply equal to 6. But here, demand curve shows the different prices which consumers are willing to buy. The maximum price the consumers are willing to pay is 6. But when consumer come to the market, he can buy at 3. So consumer can save this money. This triangle represent this consumer surplus. So we can calculate consumer surplus as consumer surplus equal maximum demanded price. According to our example, it is 6 minus equilibrium price divided by 2 into equilibrium quantity. This is the way of calculating consumer surplus. According to this graph, consumer surplus is 9. Similar to this, the producer surplus also. Here, producer is willing to pay at 0, but when he comes to market, the price level is 3. So consumer as well as the producer here can get the benefit. This is called producer surplus. By using this equation, we can calculate producer surplus. Equilibrium price minus minimum price. Equilibrium price 3, minimum price 0, divided by 2 into equilibrium quantity. According to this, our producer surplus equal to 9. Consumers can save money, producers also can save, get more. Both parties are in the markets, so we can calculate economic surplus by adding consumer surplus and the producer surplus together. So economic surplus equal to producer surplus plus consumer surplus. Now you understood what is economic surplus and the consumer surplus. Now under market equilibrium, we can see consumer surplus and producer surplus. At the very beginning, I said you market equilibrium is not a static concept. It changes due to change in the forces which created market equilibrium. It means demand and supply. When demand and supply change, it will cause to change the market equilibrium. As an example, what will happen? Increase in demand. This is the market equilibrium. When increased demand curve shift rightwards because increase demand. not increasing quantity demand. Increasing quantity demand means the relationship between price and the quantity demanded. It is lower price demand. So this is called increase in demand. When increase in demand, demand curve shift rightwards. When it shift rightwards, then new point E1 is the new equilibrium point. So now equivalent price is 4, equivalent quantity is 8. Previously, equilibrium price is 3, equivalent quantity is 6. So it has changed due to change in demand curve. Similar to this, what will happen when decrease in demand? Decrease in demand. Demand curve shift leftwards, equilibrium price will come down, equilibrium quantity decreases due to change in the demand. Then we can apply a similar thing. When increase in supply, supply curve shift rightwards, the equivalent price decreases, equivalent quantity increases. When decrease in supply curve shift leftwards, then equivalent price increases, quantity decreases. This is very practical. What will happen when supply decreases as a result of flood or drought? Then supply will be less. So market price will be increased. So this is very practical. Change in demand and supply curve together. Parallelly, we can see what will happen when price increases, supply decreases, when price decreases, when demand decreases, supply increases, as well as same direction, price, demand increase, supply increase, demand decrease, supply decrease, similar. What will happen? It is also important. Next important thing is government intervention to the market. At the very beginning, we explained market equilibrium, then change in equilibrium due to change in the demand and supply curves. Now, how can government change this market equilibrium when government intervene to the market? When government intervene to the market. Here, there are different ways which government intervene to the market, imposing taxes, providing subsidies, as well as price controls. It may be minimum price or maximum price. Taxes. The source of one kind of source of government income is taxes. It's income tax or taxes from the business. But here we are going to discuss about the taxes on goods. It will affect to suppliers or producers, not for the income earners. As well as subsidies, providing subsidies to the producers, imposing taxes on producers. Yes. One of the most popular way of government intervention into the market is tax. There are two kinds of taxes, unit tax and ad valorem tax. Unit tax means taxes, fixed tax. As an example, 30 rupees per 1 kilo of potato. 30 rupees for 1 kilo of potato. 50 rupees per 1 liter of petrol. 1 gallon of petrol. It's fixed amount. But when we come to ad valorem tax, it is a percentage. When we import vehicles, then we have to pay as a percentage of value of the car. 10%, 15%, 150%. It may be different because the value of cars may be different. So it is not number of units, one car, that much. No, it is a percentage. So, but what will happen when government impose taxes? Taxes will affect to producers. So they are demotivated. They have to bear the tax. They have to pay the tax to the government. So they are discouraged. Their cost of production will be high. As a result of increasing their cost of production, they will decrease their supply. Here you can see red color curve, supply curve. Supply curve shift leftward, it means decrease in supply. Producers decrease their supply because of increasing their cost of production. So you have to keep this thing in your mind because supply decreases. When we come to the table, here price and quantity supplied, you can see here at price level 2, quantity supply is 10. Price level 4, quantity supply is 20. But when government impose taxes, producers can't produce or supply based on their previous price, because earlier price is 2, quantity supply 10. But now they have to pay 2 rupees as a tax. 2 rupees for the government also. Now they have to add these 2 rupees to the previous 2 rupees, then it will become 4. Earlier 4 rupees, now they have to pay 6, 4 plus 2. Earlier 6, now they have to pay 8, because there is a unit tax, 2 rupees unit tax. How to convert price after the tax by using a table, add tax unit value of unit tax to the previous price. Now you can use new price and the previous quantity, then supply curve shift leftwards. Okay. As an example, here quantity demanded, there is no impact on quantity demanded. So we can use this previous graph. Then when we draw new price and supply curve shift leftwards, the difference between these two lines is equal to 2. Here's an example, here 6, but when we come to here, this point, here 8. Between these two lines, the difference is 2 rupees. So that is the value of unit tax. When government impose taxes, the market price, new market price is 7 rupees. Previously 6, now 7 rupees. Then quantity supply is, market quantity is 25. When we come to new market quantity from this point, then previous supply curve cuts here. So this is the price for producers. Producers take 5 rupees as the price. Consumers pay 7 rupees. The gap between 7 and 5 will go to the government. Okay. This is the concept of tax. Here. This part is for the consumers, increase in price. Below part is for the producers. Yes. But according to our previous calculation, we calculated consumer surplus and producer surplus at market equilibrium. But now if we calculate it, this triangle will be the dead weight lost of a tax. So this is the impact of taxes. Later on, I'll explain how to use demand and supply equations to calculate tax. Now we are going to discuss subsidies. It is similar to tax, but tax discourages producers. But when government provides subsidies, producers are motivated. They will increase their supply in the market. So it's a negative tax. Here you can see supply increases. When you see this table, earlier price 2 and supply 10. Now 2 is given by the government as a subsidy. Now they can supply it at price level 0. Previously, prices, this is here. You can see the price after subsidy. Here, when you draw new supply curve, by using this new price, you can draw it like this. This is the previous equilibrium. Now unit subsidy 2 rupees, then supply curve shift rightwards. The difference between these two is the value of subsidy. Here you can see similar to previous diagram. Now consumers can buy at price, producers will receive 7 because 2 rupees given by the government. You understood now. Here, gain for the producers, additional previously market price was 6, now market price is 7. Previously market price is 6, now consumers can buy at 5. So both of them have taken the benefit of this unit tax based on the elasticity of demand and supply curves. It differs. This is the impact of subsidies. Yes, deadweight loss of this subsidy because government has spent this much of money to launch this project. This goes to consumers. This goes to producers, but no one take this part. So this is called deadweight loss of subsidy. Inefficient. Now, we have discussed 2 ways of government interventions: subsidies and taxes. Additionally, now we are going to discuss maximum price and the minimum price. Because when the equilibrium price is not reasonable for producers, then government will impose another price. If the market price is not reasonable for the consumer, to protect consumers, government will announce another price. So these two concepts are called price floor price and the ceiling price, or maximum price and the minimum price. Let's see it. When the government thinks that market equilibrium is unfair for consumers, to give them fairness, the legal price decided by the government is called maximum price. Maximum price is imposed below the equilibrium price because equilibrium price is not reasonable for the consumers. Here you can see market equivalent price is P, quantity is Q. Now it is not reasonable for the consumers. Then to protect consumers, government has imposed P2 price as the price ceiling or maximum price. Further, you can understand this. Here, equilibrium price is P0. Now, maximum price is P1. Maximum price is P1. Here, when government decided as the price P1, then demand curve cuts here, Q1, supply curve cuts here, Q2. There is a excess demand in the market, sorry, here excess demand in the market. Here excess demand in the market. So government should intervene again to maintain this price. As a policy, government will come to the market again creation of shortage of goods due to the excess demand, attempt to sell goods at an illegal black market price. Because previously, as well as in this diagram, you can see the Quantity supply in the market is Q2, but consumers are willing to buy at a higher price than the market price also, P2. P1 is the control price, but that shortage, under the shortage, consumers are willing to buy at a higher price, P2. That illegal price is called black market price. So government again take every possible effort to maintain this price by giving these ration cards. Especially, QR is also this kind of thing. Foreign method, rationing with distribute connecting with other goods, black market price, the impact will be the otherwise black market price. So government again try to intervene to the market to maintain the maximum price. Next one is the minimum price. Government impose minimum price to protect producers when market price is not reasonable for the producers, as well as the farmers in Polonnaruwa and Anuradhapura district, they can't survive with less price. So when they reap their harvest, merchants try to buy at a low price. So government announced that this is the minimum price. So to protect producers, government will impose minimum price. Minimum price should be imposed higher than the equivalent price, as the aim of minimum price is to give fairness for producers. So equilibrium is not enough. So to protect producers, government should fix a price above the equilibrium price. Otherwise, it will not be effective. The minimum price which implemented higher than the equivalent price is called efficiency minimum price. Efficiency minimum price for paddy, minimum price for wages, we can see in the market. Here you can see market price is 30, but it is not enough for the producers, so government will impose 50 as the minimum price. There are many repercussions, economic consequences of this minimum price, because excess production in the market, as I show you here, excess production in the market. Quantity supply is this much, quantity demand is this much. So there is excess supply in the market. Government has to buy this excess supply or to maintain this price. Okay, what should government do? If this is related to the wages, unemployment problem, there is no demand, excess supply in the market, excess investment can be occurred. So government should buy this buffer stock, or government should apply deficiency payment system. I'm not going to discuss these things in here, but try to look at the questions. When we come to 2023 January paper, consider the following demand function and supply function in relation to the commodity. You have to realize, you have to understand the reality. Each and every paper consists demand and supply equations and market equilibrium question. So you have to pay your attention on this question. Calculate the equilibrium price and the quantity. You can go to AAT website, then you can refer examination papers, then you can see what are the questions. I downloaded one paper. Here, this is the question. Calculate the equilibrium price and the equilibrium quantity. QD equal QS can be applied here. Calculate the new equilibrium price and quantity after the unit tax. So the important thing is how to use equations to calculate the impact of unit tax. This is the novelty of today. Here, demand equation is QD equal 17 minus 0.05p QS equal minus 1 plus 0.1 P. At equilibrium, you know QD equal QS. So you can equalize QD into QS. Here, 17 minus 0.05 P equal 1 minus 1 plus 0.15. When you take P as a subject, here equilibrium price is 120. You can substitute this price into demand equation or supply equation to find the equilibrium quantity. When we substitute it to the demand equation, then equilibrium quantity is 11 units. When you substitute it to the quantity supply equation, it's also 11 because at the market equilibrium, quantity demanded equal to quantity supplied. So this is the equilibrium. Wherever you find equilibrium, you have to equal quantity demanded into quantity supply. Then you can find the equivalent price and the equilibrium quantity. Next, new. After imposing tax, what will happen? It will affect to suppliers, producers. So supply curve will change because previously you can remember market price will be increased. Consumers will pay the market price. Then producers received less. There is a difference between PB, consumers price for consumers, as well as PS, price for the producers. When you come to demand curve, it is PB. When you come to supply curve, it is PS. According to this diagram, you can see now new cutting point here. When you come to this cutting point, it is PB. PB means price for the consumers. When you come to new market quantity, the previous supply curve cuts here, it is called PS. The difference between PB and PS, it is equal to T. So you can apply PB and PS for the supply and demand equations. When you apply PB to the demand curve, it is very easy. When you apply PS to the supply curve, it is very easy. But when you apply tax, you have to take the supply equation because producers are paying the burden. Firstly, cost of production will be increased for the producers. So take supply equation. So I took QS equal, I took it as QS equal minus 1 plus 0.1. Previously, we had P. Instead of P, we substitute PB minus T. Why? PB minus T means consumers, what is the price consumers pay in the market minus tax equal to producer's price. Previously, can you remember? 7 is the market price, 5 is the producer's price, but 2 is the tax. 7 minus 2 is 5. 7 minus 2 is equal to 5. So PB minus T. Instead of T, we can substitute 30. 30 is the tax. Now, supply equation will be changed as minus 4 plus 0.1 PB. Previously, QS equal minus 1 plus 0.1 P. Now, it has changed as minus 4 plus 0.1 PB. Now, you can equal quantity demand to the quantity supply, but supply equation is newly generated supply equation. Quantity demand is 17 minus 0.05 P. New supply equation is QS equal minus 4 plus 0.1. Now you substitute it, then PB will be generated as 140. 140 is the PB. Now you can substitute 140 to the demand curve. Then quantity, equilibrium quantity in the market is 10. Previously 11, now 10. Previously market price is 120, then now 140. When you substitute it to QS equation, again 10 units will be there. So this is very easy. What you should do is you have to substitute PB minus T to the supply equation P. Now, when you come to the end, you can see here yes, this is the final results of our numerical example. Previously, we had an equilibrium. Equilibrium price was 120. Equilibrium quantity was 11. But after imposing 30 rupee tax, now market price is 140. The price for the producers is 110. Then difference between 140 and 110 will be the tax. 30 is the unit tax. Then 30 will goes to the government. It will be the government revenue. So no need to discuss that kind of thing. But you have to apply tax to the market equilibrium. This is the way of finding tax. So what we discussed today is we discuss the content of our lesson, demand, supply, and market equilibrium and the government intervention. Then we discuss what is equilibrium. Then we discuss change in equilibrium. Then we discuss government intervention to the market. We discuss imposing taxes, providing subsidies, maximum price and the minimum price. These are the things we discussed today. You can do more and more examples by referring to past papers, and as well as you can check it by using suggested answers also, which are included in the AAT website. So this is the conclusion, as well as this is the final of our presentation. Good luck for everyone.